For months, investors have been watching silver with growing confidence. The charts looked bullish, technical indicators aligned, and many believed a powerful breakout had finally begun. But markets rarely move in a straight line. Just when momentum appeared unstoppable, a shocking event changed everything. The breakout that so many traders expected has suddenly been crushed, leaving investors asking one critical question: was this just a temporary setback, or is something much bigger happening behind the scenes? In today's analysis, we'll uncover what triggered this dramatic reversal, why smart money is reacting differently than the public, and what every silver investor should understand before making their next move. For months, silver had been quietly building the kind of chart pattern that captures the attention of traders around the world. Unlike dramatic one-day price spikes, the most meaningful moves in financial markets often begin with weeks or even months of patient accumulation. Prices gradually stabilize after a period of weakness. Volatility starts to contract, and buyers consistently step in every time the market pulls back. To experienced investors, these are often the early signs that sentiment may be changing. While casual observers see a market moving sideways, professionals are often asking a different question: who is buying, who is selling, and what could be developing beneath the surface. That was exactly the environment surrounding silver. Following periods of sharp swings, the metal began trading within a relatively defined range. Each dip attracted buyers, while each rally encountered resistance. This back and forth created anticipation because markets cannot remain compressed forever. Eventually, they tend to break decisively in one direction. The challenge is determining which direction will ultimately prevail. Technical analysts often pay close attention to these consolidation phases because they can reveal important information about market psychology. A consolidation is not simply a pause. It represents a temporary balance between buyers and sellers. Bulls believe prices should move higher based on improving fundamentals or growing demand, while bears argue that existing conditions do not justify significantly higher valuations. As this disagreement continues, trading volume volatility and price action combine to create patterns that many investors monitor carefully. One of the reasons silver attracts so much attention during these periods is because of its unique position among commodities. Unlike many metals that are driven primarily by industrial demand or primarily by investment demand, silver is influenced by both. It is used extensively in electronics, renewable energy technologies, medical equipment, electrical components, and numerous manufacturing applications. At the same time, it has a long history as a monetary metal that investors purchase during periods of economic uncertainty. This combination often makes silver more volatile than gold. When economic optimism improves industrial expectations, silver can benefit. When financial uncertainty increases investment demand for precious metals, silver may also benefit. Because two powerful forces can influence the same asset simultaneously, price movements often become larger and faster than many participants expect. Leading into what many believe was a breakout, several factors appeared supportive. Inflation remained an important topic across global markets. Central bank policies continued attracting close attention. Interest rate expectations shifted frequently as investors attempted to interpret incoming economic data. Manufacturing activity in several sectors showed signs of stabilization, while demand projections for technologies using silver continued receiving considerable discussion among analysts. Market participants also watch currency movements carefully. Since silver is commonly priced in US dollars, changes in the dollar's strength often influence commodity prices. A weaker dollar can make silver relatively less expensive for international buyers, potentially supporting demand. Conversely, a stronger dollar can create additional pressure. These relationships are not perfect, but they remain important considerations for traders evaluating broader market conditions. Meanwhile, investor sentiment toward precious metals gradually improved. Exchange-traded products holding physical precious metals experienced periods of renewed interest. Discussions across financial media increasingly focused on inflation protection, portfolio diversification, and potential long-term opportunities within hard assets. While optimism alone cannot sustain a rally indefinitely, improving sentiment often contributes to stronger buying activity. Technical charts seem to reinforce this growing confidence. Analysts pointed to higher lows developing over several months, suggesting buyers were becoming increasingly willing to enter positions at progressively higher prices. Resistance levels that had previously rejected advances appeared to weaken as repeated tests absorbed available selling pressure. Many chart watchers consider multiple tests of resistance significant because every attempt can gradually reduce the number of sellers willing to defend that price area. Momentum indicators also became subjects of discussion. Some traders observed improving relative strength, while others pointed toward moving averages beginning to align more favorably. Although no single indicator guarantees future price direction, multiple signals pointing toward increasing strength can encourage additional participation from technical traders. Volume patterns added another layer of interest. During healthy advances, many analysts prefer to see expanding volume accompanying price increases. Strong participation suggests conviction among buyers rather than isolated speculative activity. While volume interpretation varies depending on market structure, higher activity during advances often strengthens confidence in a developing trend. Market expectations also play a critical role during potential breakout periods. Financial markets are driven not only by present conditions, but also by future expectations. Investors constantly attempt to anticipate tomorrow's developments before they become obvious. If enough participants expect improving conditions, buying can accelerate well before those improvements appear clearly in economic reports. This anticipation creates an interesting feedback mechanism. Rising prices attract attention. Increased attention encourages additional buying. Additional buying can further strengthen prices, reinforcing confidence among participants who initially hesitated. At the same time, skeptics watching from the sidelines begin reconsidering their positions. Some eventually decide to participate, creating additional upward momentum. Yet experienced investors understand that expectations can sometimes become excessive. Markets frequently move ahead of confirmed information. Optimism can become fully reflected in prices long before underlying developments justify those valuations. This does not necessarily mean expectations are wrong, but it increases sensitivity to unexpected news or disappointing data. Silver's history provides numerous examples of this phenomenon. The metal has experienced remarkable rallies followed by equally impressive corrections. Its relatively smaller market size compared with many other major asset classes often contributes to amplified price movements. Large buying or selling flows can produce significant changes in relatively short periods, especially during periods of heightened uncertainty. Professional investors therefore rarely focus on a single indicator. Instead, they evaluate multiple variables simultaneously: economic growth, inflation expectations, monetary policy, industrial production, mining supply, recycling activity, investment demand, currency movements, geopolitical developments, and market positioning all contribute pieces to a much larger puzzle. One particularly important concept involves positioning itself. Market positioning reflects how investors are already allocated before major moves occur. If most participants have already established bullish positions, there may be fewer new buyers available to sustain continued advances. Conversely, if skepticism remains widespread despite improving fundamentals, substantial buying power may still exist as opinions gradually change. This balance between expectation and reality often determines whether breakouts succeed or fail. A convincing breakout requires not only optimistic expectations, but also sufficient new demand to absorb selling pressure. If buying enthusiasm fades too quickly, resistance can reassert itself, causing prices to retreat back into previous trading ranges. Retail investors frequently experience emotional challenges during these moments. Watching prices approach important resistance levels creates excitement. Financial headlines become increasingly optimistic. Social media discussions multiply rapidly. Success stories receive widespread attention, encouraging fear of missing out among individuals who remained cautious earlier. Professional investors attempt to manage these emotions through disciplined analysis. Rather than reacting solely to headlines or daily price fluctuations, many evaluate broader trends across multiple timeframes. They recognize that sustainable trends usually develop over extended periods rather than within a single trading session. Risk management also becomes increasingly important during anticipated breakouts. Even when probabilities appear favorable, uncertainty never disappears completely. Position sizing, diversification, and clearly defined exit strategies help investors navigate unexpected developments without allowing individual trades to dominate overall portfolio performance. Historical perspective further reinforces this discipline. Every major bull market contains temporary setbacks. Every prolonged bear market experiences powerful rallies. Distinguishing between temporary fluctuations and genuine trend changes remains one of investing's greatest challenges. No indicator consistently provides perfect answers. Economic reports released during this period attracted considerable attention as well. Employment figures, inflation data, manufacturing surveys, consumer spending reports, and central bank communications all influenced market expectations. Investors constantly reassessed how new information might affect interest rates, economic growth, and demand for precious metals. At the same time, industrial demand forecasts continued evolving. The global transition toward renewable energy technologies generated ongoing discussions regarding silver consumption in solar applications, electrical infrastructure, and advanced manufacturing. Analysts debated whether structural demand growth could provide long-term support even during periods of economic uncertainty. Mining supply represented another important consideration. Developing new mining projects often requires years of exploration, permitting, financing, and construction. Existing operations face challenges ranging from declining ore grades to rising production costs and environmental regulations. These supply-side factors contribute to long-term market dynamics, although short-term price movements often remain dominated by investment sentiment and macroeconomic developments. Another element influencing expectations involved global diversification strategies. During periods of elevated uncertainty, institutional investors sometimes reassess portfolio allocations across equities, bonds, commodities, and alternative assets. Precious metals frequently become part of these broader discussions because of their historical role in diversification. Although allocation decisions vary significantly depending on individual investment objectives and market outlooks throughout this period, confidence steadily increased among those expecting higher silver prices. Technical patterns appeared constructive, market sentiment improved, discussions surrounding industrial demand remained active, inflation concerns persisted, currency movements occasionally offered additional support. Combined together, these developments encouraged many investors to believe silver might finally be preparing for a sustained move beyond its established trading range. As anticipation intensified, attention increasingly shifted toward the critical resistance levels that had repeatedly limited previous advances. Traders monitored each trading session carefully, searching for confirmation that buyers possessed enough conviction to overcome remaining selling pressure. Every incremental gain fueled additional optimism, while every temporary setback prompted renewed debate regarding whether the market simply required more time before making its next decisive move. For much of the buildup, market participants had become increasingly focused on the technical picture. Price action appeared constructive, volatility had narrowed, and optimism was growing that silver might finally move beyond a resistance level that had frustrated buyers on multiple occasions. But financial markets have a way of reminding investors that confidence alone is never enough. Even the strongest-looking setup can change rapidly when new information enters the market or when expectations shift faster than prices can adjust. The event that interrupted silver's momentum was not necessarily a single headline that everyone interpreted the same way. In real financial markets, price reversals are often driven by a combination of factors arriving within a short period. A stronger than expected economic report, changing expectations for interest rates, a sudden move in the U.S. dollar, rising government bond yields, or a broader shift in investor sentiment can all influence precious metals simultaneously. Rather than looking for one dramatic explanation, experienced investors usually examine how several developments interacted to create a powerful market reaction. One of the first areas traders examined was the U.S. dollar. Because silver is internationally priced in dollars, movements in the currency often affect demand. When the dollar strengthens, it can make silver more expensive for buyers using other currencies. That relationship is not perfect and does not determine price movements every day, but it remains one of the most closely watched indicators in the precious metals market. Suppose economic data arrives stronger than expected. Investors may conclude that the economy is more resilient than previously believed. That can influence expectations for monetary policy, interest rates, and capital flows. If those expectations encourage demand for the dollar, precious metals sometimes experience selling pressure as traders reassess their outlook. Interest rate expectations also play a significant role. Silver does not generate interest or dividends. When investors believe interest rates may remain elevated for longer than anticipated, some may shift capital toward assets that provide income. This does not automatically create a bear market for silver, but it can reduce buying enthusiasm, particularly among short-term traders responding quickly to changing macroeconomic conditions. Government bond yields often become another important piece of the puzzle. Rising yields may signal that investors expect stronger growth, persistent inflation, or changes in central bank policy. Whatever the underlying reason, higher yields can alter the relative attractiveness of different asset classes. Market participants constantly compare potential returns across stocks, bonds, commodities, and currencies, adjusting portfolios as expectations evolve. The key point is that none of these variables operate independently. Financial markets function as interconnected systems. A stronger economic report may influence interest rate expectations. Those expectations can affect bond yields. Bond yields may influence currency markets. Currency movements can affect commodity prices. At the same time, equity markets respond to the same information, creating additional feedback loops that shape investor behavior. When multiple factors begin moving in the same direction, market reactions can accelerate quickly. Traders using quantitative models may receive similar signals at nearly the same time. Algorithmic trading systems respond automatically to changing prices and volatility. Institutional investors rebalance portfolios based on predefined risk parameters. Retail investors react to headlines and rapidly changing charts. The combined effect often creates larger price movements than any single participant intended. Another important aspect involves expectations versus actual outcomes. Markets do not simply respond to good or bad news. They respond to whether information differs from what investors had already anticipated. If traders overwhelmingly expect one outcome, but reality turns out slightly different, prices can move sharply even though the underlying news appears relatively modest. This distinction is essential because markets spend much of their time pricing future expectations rather than current conditions. By the time an economic report is released, investors have often spent weeks estimating what the numbers might show. When actual results differ from those estimates, rapid repricing follows as participants update their assumptions. Silver's apparent breakout developed in an environment where optimism had gradually increased. As confidence expanded, positioning became more heavily tilted toward expectations of higher prices. That does not mean optimism was unjustified. It simply means the market became increasingly sensitive to developments that challenged the prevailing narrative. Risk management also contributed to the reversal. Many traders place protective stop-loss orders beneath important technical levels. These orders help limit potential losses if markets move unexpectedly. During normal trading conditions, they provide valuable discipline. However, when large numbers of traders use similar technical reference points, price declines can trigger multiple stop-loss orders almost simultaneously. As those orders execute, selling pressure increases. Additional selling pushes prices lower, activating even more stop-loss orders. This chain reaction sometimes creates temporary declines that appear larger than the initial catalyst might otherwise justify. Leverage can further amplify these moves. Futures markets allow participants to control relatively large positions using comparatively small amounts of capital. While leverage increases potential returns when prices move favorably, it also magnifies losses when markets move against expectations. Traders facing margin requirements may be forced to reduce positions quickly, adding further selling pressure during periods of heightened volatility. Institutional investors approach these situations somewhat differently than many individual traders. Large funds often maintain diversified portfolios with exposure across multiple asset classes. Rather than making decisions based solely on one commodity, They evaluate broader macroeconomic trends, correlations, and portfolio objectives. If market conditions change significantly, adjustments may occur across numerous positions simultaneously. Portfolio rebalancing is a routine part of institutional investing. Strong performance in one asset class may increase its weighting beyond target allocations. To restore balance, managers may reduce positions even if they remain optimistic about long-term prospects. These transactions reflect risk management rather than necessarily indicating a negative long-term outlook. Liquidity conditions also deserve attention. During periods of lower trading volume, relatively modest orders can produce disproportionately large price movements. If buying interest temporarily declines while selling pressure increases, prices may move quickly until new buyers emerge. This is one reason intraday volatility can sometimes exceed what underlying fundamentals alone would suggest. Market psychology often intensifies these dynamics. Confidence tends to build gradually during rallies. Investors become increasingly comfortable with bullish narratives as prices continue rising. Eventually, many participants begin treating recent trends as though they are guaranteed to continue. This shift from cautious optimism to widespread confidence creates vulnerability because expectations become increasingly one-sided. When prices unexpectedly reverse, psychology changes just as rapidly. Traders who recently feared missing the rally suddenly begin worrying about protecting profits or limiting losses. Headlines that previously emphasized bullish developments shift toward discussing risks. Social media conversations become more emotional. Small price declines receive outsized attention because they conflict with recent expectations. Experienced investors recognize this emotional cycle as a recurring feature of financial markets. Fear and greed rarely disappear. Instead, they alternate as conditions evolve. Successful investing often requires maintaining discipline while others react emotionally to short-term fluctuations. Another consideration involves technical resistance itself. Resistance levels represent areas where selling previously overwhelmed buying. Breaking above resistance often requires sustained demand rather than a brief burst of enthusiasm. Sometimes prices move slightly above resistance before retreating back below it. Traders refer to these episodes as false breakouts or failed breakouts. A failed breakout does not automatically imply a long-term bearish trend. In some cases, markets retreat temporarily, attract new buyers, and eventually attempt another advance. In other situations, the failed breakout signals weakening momentum that leads to more prolonged corrections. Distinguishing between these possibilities requires continued observation rather than immediate conclusions. Analysts therefore examine additional evidence beyond price alone. Trading volume, volatility, market breadth, options activity, positioning data, macroeconomic developments, and cross-market relationships all contribute valuable context. No single metric provides complete certainty, but together they help build a more balanced assessment. Industrial demand expectations remain part of the broader discussion as well. Silver occupies an unusual position because it functions both as an industrial commodity and as a precious metal investment. Manufacturing trends, renewable energy deployment, electronics production, and technological innovation all influence long-term consumption expectations. These structural factors typically evolve gradually rather than changing dramatically from one week to the next. Because of this, short-term price declines do not necessarily indicate sudden changes in physical demand. Financial flows often dominate shorter timeframes, while industrial consumption influences longer-term trends. Understanding this distinction helps explain why market prices sometimes move sharply despite relatively stable supply and demand fundamentals. Mining supply also changes slowly. New projects require extensive planning, permitting, financing, construction, and operational development. Existing mines face ongoing challenges related to costs, geology, labor availability, and environmental standards. These realities mean physical supply usually cannot respond quickly to sudden changes in investment sentiment. Global geopolitical developments added another layer of uncertainty. International trade relationships, regional conflicts, energy markets, and government policy decisions